Every major financial upheaval begins quietly. A strange data point, a sudden move by a major institution, a surge that no one can fully explain until it's too late. And right now, that early signal is flashing again. Silver has broken through every historical ceiling. Institutional players are shifting massive amounts of physical metal behind the scenes, and a pattern that shows up in every major crisis appears to be completing once more. The question is simple. Are we witnessing the beginning of the biggest revaluation of silver in modern history, or the final calm before the eruption? Today, I want to walk you through the evidence, the historical echoes, and the hidden moves from the world's most powerful bank that raise a single alarming possibility: the silver market may be heading toward an event no modern investor has ever seen. Silver crossed 59 per ounce on December 6, 2025, the highest level ever recorded. But the price spike isn't the most unsettling part. What caught my attention was a report that JPMorgan quietly shifted roughly 169 million ounces of silver into their vaults around the same time. If industry estimates are accurate, that alone represents nearly 10% of the world's above-ground supply. And here's what makes that number even more significant. JPMorgan has been accumulating silver for over a decade, slowly, quietly, methodically. If silver were meaningless, as many analysts claim, why would the most influential bank in the United States build one of the largest private stockpiles ever assembled? I've spent months studying previous financial crises, and the same pattern shows up every time, four distinct stages that repeat with stunning consistency. And based on everything unfolding right now, I believe silver is entering the final stage, the eruption phase. Before we explore that, a quick reminder: I'm not your financial advisor. This is an educational breakdown built on publicly available information. Do your own research. Stage 1, the setup. Every crisis starts with a manufactured sense of stability. Regulators and institutions build systems that make markets look calm, even when they aren't. In silver's case, this began after the Hunt brothers' dramatic corner attempt in 1980. Authorities responded by expanding the paper silver market, futures contracts, derivatives, instruments that represent silver but are not actual metal. Some analysts estimate the paper market may be 50 times bigger than the physical market. COMEX data suggests open interest is more than double the amount of silver actually vaulted. In simple terms, if even a fraction of contract holders demanded real metal, the system could face severe strain. Stage 2, expansion. After stability comes expansion, more debt, more printing, more promises. Since 2008, central banks had added trillions to global money supply, yet silver remained suppressed for years. Why? Because whenever physical demand rose, large institutions reportedly countered with new waves of paper contracts, short positions, and derivative exposure. But something quietly shifted in the background. Industrial demand exploded. Silver is essential for solar panels, EVs, 5G components, medical devices, and AI hardware. Industry consumption now appears to make up nearly 60% of global silver use, up sharply from a decade ago. Meanwhile, mining supply hasn't kept up. Reports indicate production has declined by roughly 7% since 2016, and silver has been in structural deficit for several consecutive years. Above-ground reserves are being drawn down fast. India's imports set new records, China keeps buying, and inventories on major exchanges have steadily thinned. Through all of this, JPMorgan's accumulation never stopped. Various analysts estimate they may now control over 600 million ounces, surpassing what the Hunt brothers, Berkshire Hathaway, or even some countries have ever held. When JPMorgan inherited massive short positions after the Bear Stearns collapse, they didn't just unwind them, they flipped their stance entirely. They went long, very long. Stage 3, the break. Stage 3 is where the system cracks. It's the moment everyone suddenly wants the real thing instead of paper claims, and I believe that's the phase unfolding right now. On November 28, 2025, the CME, the heart of global derivatives trading, suffered an outage that lasted more than 10 hours. While the exchange was offline, silver shot to nearly 57 per ounce. When trading resumed, spreads were chaotic. That kind of instability is what happens when liquidity evaporates. Then something even more telling occurred. JPMorgan reclassified over 13 million ounces of silver from registered to eligible. In the middle of a supply crunch, they effectively removed around 9% of the deliverable market. Around the same time, silver lease rates exploded, reportedly hitting near 30% annualized. That means people were so desperate for physical metal, they were willing to pay double-digit interest just to borrow it. That is not normal behavior. That is an emerging squeeze. And now, with silver nearly doubling within a single year, the pattern resembles previous crises almost perfectly. Stage 4, the eruption. This is the phase where price stops behaving rationally. Small imbalances become massive shortages. Short sellers get crushed. Institutions that prepared early make staggering gains. We saw this in 1979. 1980, when the Hunt brothers drove silver from around 6 to nearly 50 and 800% surge, before rules were changed overnight to stop them. But the price spike itself was real. The shortage was real, and the system had to change its own rules to prevent a total collapse. We've seen similar dynamics in 2008 when paper mortgage assets imploded, sending gold from roughly 720 to over 900 within 3 years. When confidence in paper evaporates, capital runs to real assets. Today, all the ingredients of an eruption are present. Historically low inventories for rising industrial demand, the multi-year supply deficits, the surging premiums, lay in a banking giant position for massive upside. Even conservative forecasts have been blown apart. JPMorgan's own projection of 38 silver for late 2025 was shattered months early. Analysts targeting 35, 40 have been left behind. Some independent forecasters see 75 and 90 by 2026, but those estimates assume the paper market holds together. If it doesn't, if the silver to gold ratio reverts toward historical norms, if delivery failures increase, we could see prices far above anything analysts are willing to say publicly. Adjusted for inflation, silver's 1980 peak is worth about 170 today. And that was during a smaller deficit, lower industrial demand, and a much smaller paper market. The coming catalyst, the Federal Reserve meets on December 9th and 10th, just days away. Markets currently expect a rate cut. If that happens, the dollar likely weakens. When the dollar weakens, gold and silver historically surge. Gold already sits above 4,200 with projections pushing toward 5,000 next year. Silver moves later, but always harder. The setup is simple. A structural deficit to fuel, JPMorgan accumulation of pressure, a key OMX tensions to ignition, Fed policy to spark. If these factors converge, the next move may not be gradual. It could be sudden, violent, and irreversible. Premiums are already rising. Some dealers report delays. Physical silver is still available today, but that window may not remain open much longer. When paper markets crack, premiums can skyrocket 40%, 50%, even 60% above spot, just like during the 2020 panic when 28 silver sold for 45 in physical form. At the current pace of inventory drain, KOMX registered silver could fall below stress levels within months, perhaps faster if buying accelerates. The larger issue, silver's story, is really a symptom of something deeper. Pressure inside the global currency system. Since 1971, the dollar has been pure fiat, backed not by metal but by confidence. After decades of money creation, debt expansion, and accounting changes that hide true inflation, many analysts believe a reckoning is unavoidable. Silver at 59 may simply be the first warning shot. Scarce assets are repricing. The market is signaling that decades of paper promises cannot continue forever. In my view, silver remains one of the most mispriced, scarce assets in the world, undervalued relative to gold, industrial demand, and the scale of currency expansion. If the market corrects that imbalance, the move could be historic. It took nearly half a century for silver to break its old record. 45 years of buildup, 45 years of suppression, 45 years of coil tension, and the spring is finally releasing. JPMorgan may have learned what the Hunt brothers never understood: patience. Instead of forcing the squeeze, they simply positioned themselves and let the system tighten naturally. And now, every major signal, supply, demand, inventories, bank activity, is pointing in the same direction. This isn't the beginning. It isn't the warning phase. It's already happening. The only question is whether investors recognize it in time. And with the Fed meeting only days away, the next major move may be closer than anyone expects.